Who do you think creates and allocates the majority of the money supply? The general public believes, well, it's the government or the central bank who are creating and allocating the money supply. This is not how it functions. Would you agree with a financial system whereby private profit-oriented enterprises create and allocate the majority of the money supply according to their own decisions? Banks create the money supply, and they do this when people borrow money. So if you go to the bank and you take out a bank loan, the bank will pretend that you have deposited the money. And that's how they'll fill the accounts, and nobody can recognize it. That's effectively how the money supply is created, because they're the accountants of all the transactions that are not taking place in cash, which is 97, 98% of the transactions. Anything bigger tends to be non-cash. So if you give your money to the bank, it's called a deposit. Is it owned by the bank and therefore at risk if the bank fails? Who's going for that option? Okay, quite a few. Or B, it's held in custody and therefore not affected by the failure of the bank. Okay, in the banking system, with the bank, the money is owned by the bank. It's not really a deposit. It's not held in custody. It's not a bailment. The bank owns the money. You just general credits to the bank. Some of the trade secrets of banking. The unknown legal realities of the banking business. Number one, banks do not take deposits. And number two, banks do not lend money. So what happens legally when a deposit is made with a bank? Legally, the customer has no money at the bank or on deposit, but it's a loan to the bank. There is no such thing as a bank deposit. It's just the banks are borrowing money from us. The depositors are lending their money to the bank. And what the bankers proudly call their huge amount of deposits is just their debt. That is the bank's debt to society. Number two, banks never lend money, unlike normal firms. In the case of normal firms, insurance companies, they do lend money, but not banks. What banks do is they acquire securities. They purchase securities. So you go to the bank and you say you want to get a loan. The bank will make you sign a loan contract, a loan agreement. Legally, that's considered a promissory note, and the bank is purchasing that. Of course, it also says that the bank should now pay you something, but the bank will not pay out. It will just record its debt to you, which is called the deposit, and we use it as money. Isn't that handy? So they don't actually have to pay up, and they do not pay up. So the way it works on the balance sheet is that the loan contract, we're obviously not talking about £1,000 here, but £1,000 million. So on the bank balance sheet, this looks like the amount of the loan, say £1,000. This is the value of the security that the bank is purchasing, is therefore shown on the asset side, as the bank is buying this, and therefore has more assets. And then it shows its debt to the borrower as a liability. Technically, it actually has an accounts payable liability from the loan contract, as it should pay out. It is, and this is where I think there is actually a good reason for a legal challenge, it is misrepresenting this accounts payable liability as a customer deposit, which is a different type of liability. And it's misrepresentation because the customer didn't deposit this, and the bank didn't deposit this. Nobody deposited it, it's invented money. So this is shown here. And so when you see the amount of money as a borrower in your account, this, shown as a liability to the bank, was just invented. It wasn't transferred from any other account inside the bank. It wasn't transferred from any other account outside the bank. This is how virtually the entire money supply is created. What's not created this way is cash, notes and coins. But that's only 3% of the money supply in most countries. So the non-cash money is entirely created by the banks. Well, if banks create money, well, how come they can go bust? Of course, they do have to make the books balance. This case of Credit Suisse, and it seems also Barclays Bank, is quite instructive. So September 2008, as you remember, the so-called global financial crisis, where it was a European and US financial crisis. A lot of banks were bust. They needed capital. So Barclays and Credit Suisse, same case, it seems they needed around £7 billion in new capital. So these banks, and Credit Suisse, basically, it's not disputed with Barclays. Barclays sort of tries to indicate that, no, this is not what happened. So, consider the story mainly about Credit Suisse, but it seems that it's very similar in the case of Barclays. They thought, well, since we're already inventing money, why don't we invent our own capital? To do that, you need a straw man. You need another counterparty outside the bank. And of course, if we're talking about 7 billion, and you invent money by getting somebody to borrow this money, because you need a fairly large counterparty. So why not the oil sheiks in the Gulf states, where banks like Barclays had fairly close relations and dealings? Qatar, it turns out, was willing to engage in the discussions and was persuaded to buy newly issued shares of Barclays. And when you issue shares, you raise your capital. But Qatar said, we don't want to sell our stock holdings. The stock market has just crashed, and we don't have the liquid funds. And Barclays said, well, no problem. We lend it to you. So Barclays prepares the loan contract. When Qatar signs, Barclays purchased the loan contract of Credit Suisse, and that's recorded on the asset side of the balance sheet. Then you have an accounts payable liability. The lender owes the borrower the money, so accounts payable liability. You then swap that, as banks always do, into a deposit, customer deposit that nobody's deposited. And then you do the liability swap of issuing new equity, which is also on the liability side, and you transfer the deposits into equity. And there you go. Now you've got 7 billion more in equity. Of course, this is illegal, so it is a case for the Serious Fraud Office, but it seems not a very urgent case at all. And as I said, in the case of Credit Suisse, the regulator said, all right then, okay, we'll let you do that, but next time, don't do such naughty things. What about other forms of money? Cash, roughly 3% of the money supply. What about this quantitative easing that people are talking about? Well, when central banks inject money into financial markets or into financial institutions, this is done through the central bank crediting the bank's accounts at the central bank. And it's the same game. So the banks have accounts with the central bank, and the central bank purchases things from the banks and credits their accounts with the central bank. Now, what is that credit? What sort of money is that? Well, that's again invented money. But it's a different type of invented money. That these are reserves held at the central bank. They're called reserves, and it's like the bank credit that the banks invent the deposits, but it's always at the central bank, so it never circulates. It can't be injected into the economy. Now, since the money supply is created and allocated by banks, that does make them pretty powerful, because they make the decision how much money to create and who to give it to. And the shocking thing is that, this has been going on for centuries. Nobody seems to have thought of encouraging, to put it mildly, the bankers to do the right thing. Maybe, think about the implications this may have, whether you create money, certain amounts, and give it for a certain project or another type of project, will of course, over time, reshape the entire economic landscape. And Ireland has seen quite a bit of reshaping, I believe, in the past decade or two. There are no such rules imposed on the banks. In fact, the regulator is saying, no, your job is to maximize profits. Turns out they then focus on particular types of activities that are particularly harmful because that's how they maximize their profits. Now, the problems in banking in such countries like the UK, the UK is a good example because it's really the historical origin of this type of financial system. Modern banking was created in the 17th century in the UK. When we look at the UK, we notice that key problems have already been recognized for the entire last century. You can go through a string of government report, commission report, and expert report, this, that, and the other, for the past century, dozens and dozens of reports. They always conclude the same thing. Say, Macmillan Committee, 1931, they had, this was a parliamentary committee, and they invited testimonials from bankers, all sorts of concerned parties, and the bankers seemed to have been reasonably honest. They told them, well, when customers of other banks come to us, we turn them away because we don't want to poach other banks' customers. That's an agreement between us banks. Economic historians have actually uncovered those written documents where you have these written agreements. There's a circular was going around, it was found later, 1938, quote, "It has been agreed by the clearing banks," this is the cartel of the big banks, "that in the present circumstances and until further notice," probably it has never been given, "no bank will take an account from another bank." Now, one has to, in fairness, point out that there's always going to be collusion in banking. And that's related to the way banking works. Banks need to cooperate to do their job. And when you have to cooperate, then it's a small thing to move from cooperation to collusion. And that's in the clearing of transactions. In the UK, it's particularly obvious because it's a private group of banks. They're the clearing banks, what used to be called the London Clearing House, private, the big banks. But we've heard, of course, all the court documents in the last 6 years about one market after another being fixed and rigged by the big banks, so it's not a surprise. But keep in mind that this is where banking is different from other industries, and that has to have implications about how banking should be shaped. So if you buy a BMW makes the cars, actually fairly close to where I was born. It's the biggest factory in Bavaria, that's the B in BMW. And they make the cars, you buy them, okay, you drive them, that's BMW. And you can get an Italian car, Fiat, or something like that, and it doesn't affect a BMW. Fiat can produce their cars and do what they want with the cars, and you drive them. There's no connection. But with banks, it's different. If you go to your bank can't do its job and do its business without cooperation from the competition, from the other banks. It does not work if the other banks don't cooperate. So the BMW doesn't work if there's no cooperation with Fiat. It's quite extraordinary, really. So that means we have to really think about how we structure this industry, because it's clear you will get a lot of collusion and cartels. But you can go further back. You can go back to 1918, so a century back. The Colvin report, another committee, Treasury Committee in London, studied the banking system and the problems and concluded it's it's a problem. It's dominated by the big five. When you read this, you think it's like they get this century wrong. And what are the problems? Well, there's lack of competition. The big five dominate everything. They do not provide loans to small firms, and they do not provide long-term loans, only short-term lending. Well, hasn't changed in a century, has it? In the UK, the degree of concentration of the banking system has been particularly shocking in the last century. And this happened basically from the late 19th century onwards. There used to be many banks, also a lot of local banks, regional banks, community banks. They disappeared, amalgamations, mergers. They got very concentrated, and that's very bad. So that's recognized. Looking at the landscape of banks today, we see that, of course, in the UK, they continue to be highly concentrated. There's only 133 banks in the UK. There's a way of measuring this statistically, the degree of concentration, this index, Herfindahl-Hirschman index, HHI. It's the sum of the bank's squared market shares. And we get a reading of 1,600, 1,700. Now, anything above 1,000 in this index is concentrated, and anything around 1,800 is highly concentrated. Now, you have to take out of these 133 banks those that are not actually operating for UK customers. Namely, there's many large international banks that operate offshore and international transactions. So in that sense, they're not really UK banks. Take them out, so you're left with 121 banks, and of course you are well above 1,800 in terms of concentration of banks. And that's true for assets, for loans, and for deposits. So it's one of the most highly concentrated banking sectors. The figures would be probably not too dissimilar in Ireland, but I haven't studied the detailed figures. If you look at another European, well, in fact, if you look at all the European countries here, this is EU countries and the number of banks. What you see is that Germany stands out. So the tall bar here is the German, the number of banks in Germany. This is the number of banks. It's followed by Austria, and then Italy, and then Poland. These are all places where there's been a tradition of community banks. Well, the tradition is shorter in Poland, but you can see how you can create that tradition after the fall of communism. France is another one, and here's Ireland, where there's still a decent number of banks. Now, it turns out that the more banks you have, the less likely you're going to have these problems.
Well, sorry,
yeah, please.
What are you measuring here?
This is just a number.
Showing Ireland at 400.
It's the number of credit institutions.
Yeah, that's credit unions.
So in credit unions are included, yes. Yeah.
That's distortion from our point of view. We think we have 2.5 banks.
I entirely agree. Yeah, exactly. I mean, these are the official figures. This is what you get by the ECB or EU.
Are they separate legal entities, or are they all just, are you talking about the number of businesses? So it's a different argument.
Well, you have to check their definition. I think it's this number of separate legal entities. But the point is, there's some countries that have a lot, like Germany, and I want to look at those closer. Now, in Germany, therefore, the degree of concentration is far lower. So this index, HHI index, for total loans is below 400. I mean, that's pretty unprecedented, you'd think, if you compare to other countries, if you compare international banking systems. So there's less concentration, and as a result, there is more competition. The big banks always say, oh, concentration doesn't mean, there's no competition, but that's frankly a dishonest argument. Concentration is very closely correlated with competition. The more concentrated, the less competition you have. So in Germany, there's a lot of competition, a lot of choice for customers. So in Germany, we've got 1,600 community banks and a few other big banks as well. Now, all these reports where the banks, the UK banking system was studied over the past century, they did not include a comparison with a country like Germany or even the US. And it's been argued by the big bank leaders that no, you shouldn't look at Germany, that's it's just so different. And also, by the way, it's on the local level, it's as concentrated as the UK banking sector, which is quite a ridiculous argument. You can debunk that by looking at a regional banking system, such as the Bavarian banking sector, and you find that your HHI index is still 400 and something, so very low. Now, briefly, what causes the recurring boom and bust cycles, and what is the role banks are playing? Banks create the money supply, and you can divide the money creation into two streams. You may not be aware, but not everything is in GDP. We talk about the economy and the need to have GDP growth and so on, and the media report the latest GDP growth figures, but GDP actually includes very specific things. Let's call it the real economy. What it does not include is financial transactions, asset transactions, property transactions. The housing market, the transactions, they are not included. The reason for that is actually fairly sensible, because GDP, the fundamental definition is value-added transactions. So that's the verdict by the statisticians on the financial sector, on the financial transactions. It doesn't add value. Why? Well, it's a zero-sum game. If you're gaining through a financial transaction, somebody must have lost the same amount. It is a zero-sum game. So the more people are playing financial markets, or asset markets in general, the more unproductive the economy gets, because in total, it's plus minus zero. It's divide and rule, just playing people off against each other. They're betting against each other all day. Anyway, so we've got these two types of transactions. And the money supply and the money creation, which takes place through bank credit, as we saw, bank credit creation, needs to be divided into these two streams. So credit for the real economy, for GDP, that's real circulation credit, and credit for transactions that do not contribute to GDP. Non-GDP transactions, financial circulation credit. What you then can identify is the good credit creation and the bad credit creation. First of all, bank credit for financial transactions. This is the box here at the bottom right, asset credit creation. It doesn't contribute to GDP, but it has an impact. When banks lend for the purchase of ownership rights, which is what it is, asset transactions, somebody's purchasing rights, ownership rights, then because this is also money creation, this bank lending is money creation, you are creating new money and you're pumping it into one particular market, asset markets, financial markets. What has to happen? Of course, prices there have to rise. And that's the asset inflation. This leads then to boom-bust cycles, because as the asset prices rise, more people want to take out loans, the banks are happy to fuel that. But it's very fragile, because if asset prices fall only by 10%, the entire banking system is bust. But of course in the boom time, as we also heard, asset prices rise by much more than 10%. They can double, triple, quadruple housing prices, stock prices, and from that peak, if you then just have a retrenchment of 10-15%, you will get non-performing assets, and the banks cannot take many of those because they have so little equity. The equity is that is that part of the balance sheet that has to be used to make up for losses for non-performing assets, and it's far less than 10%. So banks are quickly bust. So if you have bank credit for financial transactions, which of course are unproductive, it's also unsustainable and will result in banking crises and recessions following that. If credit is used for consumption, of course you get consumer price inflation. That's also unsustainable, unproductive. But if credit is used for productive purposes, investment credit, you can have growth without inflation and without financial crises. And that's true not just when you have high unemployment to start with and then you increase productive credit. It's true even when you're at full employment. You can still have more growth without inflation. We won't have time to go into details. If you're interested, perhaps in the Q&A part. But it has to do with what it actually means to have growth. It is actually an accounting fiction, because any physicist can explain to you there's no growth. How can there be growth? Energy exists and can't be created, and you can't add to it, you can only transform it. So it's an accounting fiction created to suit banking system, surprise, surprise. But maybe we have time to return to this. Now, credit for non-GDP transactions, financial transactions, therefore creates these asset bubbles and crises. And just a few examples how this works. So in Japan, this credit for real estate was only 15% of banks lending in the early 80s, and then that doubled to 30%. And of course, that's the percentage of total lending, while total lending itself also exploded. So it had a massive, massive credit bubble. But it's nothing new. This has always happened in other places, like in the US in the 20s, Scandinavian countries in the 80s, the so-called Asian crisis was the same, banks lending for non-GDP transactions, property, UK, Ireland, Portugal, Greece. If you want to see what happened in Ireland, on this graph here on the left side, we've got the pink line is GDP, so it's fairly modest, nominal GDP below 10%, naturally. But bank credit was expanding by, between 2004 and 2007, around 30%. And you don't have to be a so-called trained central banker to know that if money creation is expanding at this pace, way ahead of the real economy, well, by definition, it's not going into the real economy. It's not in nominal GDP, right? Because that's much lower. It must go into asset markets. And it's always the same story. So it's quite obvious and quite easy to predict then, well, this is an asset bubble and you're going to have a banking bust as a result. Same, of course, in Spain, 15-20% growth of bank credit, Portugal, Greece, similar stories. So which policy has been historically most successful in avoiding these cycles and crises? The East Asian economic miracle, which is recognized by anyone really, even the orthodox economists, was due to bank credit creation being mainly used for productive purposes. This was done in Asia first by Japan. Japan introduced it into Manchuria, which is now part of China, Korea and Taiwan, which were part of Japan in those days. And those countries after 1945 then continued these policies because they saw that it's quite effective. China adopted this from 1982 when Deng Xiaoping traveled in Japan, and they explained to him how they had this high growth period. It was a system of credit guidance where the central bank tells the banks which sector to lend to or not to lend to. So in particular, it was forbidden to lend for unproductive purposes. So no consumer loans and also no asset loans. You could still get a mortgage, but it wouldn't be from a bank. It would be from special non-credit creating institutions. In other words, you have to use existing money for asset transactions, because then you don't get the negative results of using new money creation for asset transactions. And that worked really well, 10, 15, 20% growth for, well, several decades, and these countries just developed tremendously quickly. Obviously, they didn't look at environmental concerns, so that's something one can easily improve on. It wasn't a goal, but the same system of credit guidance can be used to achieve almost any result. As the Japanese central bank showed us, you can also use it to blow up the system and destroy those banks and the traditional Japanese economy, as they did in the 80s, when the Bank of Japan used the credit guidance to force the banks to increase speculative lending. Similar to how the ECB, of course, encouraged the Irish banks to expand property lending in Ireland. So remember, I mean, some people say, well, credit guidance, that's too much of an intervention. But remember, credit is always allocated. There's always a bureaucrat making allocation decision. This is what the banks are doing. It's only at the moment nobody's ensuring or even trying to encourage them to do what could be more beneficial. And with a credit guidance system, you just make this very explicit. And obviously, it should be very transparent and accountable. The alternative is to take away the power to create money from banks and give it to the government, as Positive Money is advocating. But I would be very cautious about that, because central banks have an absolutely horrendous track record. Sadly, after any crisis, they increase their powers. And this has been true of the recent crisis. They're far too powerful and unaccountable. We should not give them any more power. The centralization of power needs to be countered. This has been a major trend in the last century. What we need is the opposite: decentralization, devolution of power, and that has to be especially true of the power to create and allocate money. So to think about how we can do that, the power to create money belongs to the people, as we heard at the outset, and it needs to be returned to them. And not just on paper, on the surface, but in reality. And this can be done in a few ways that I'll discuss in a minute, but it shouldn't be given to central bureaucracies. I've got a bit more on the East Asian miracle. We can return perhaps if you're interested in the Q&A. Now, the credit guidance is, however, not the only way to do this. In fact, if the credit guidance system is abused by the credit allocators, central ones, then that's also bad. And this is the risk with the centralization of power, and Japan is really a great warning concerning that. The Bank of Japan abused that power from the 1980s to cause tremendous damage to the Japanese people in order to further an agenda that came from the outside to change the economic structure and, a structural transformation, deregulation, liberalization, privatization, the whole neoliberal agenda that's being pushed by central banks. So there is an alternative. It doesn't mean that we shouldn't introduce simple credit guidance in the form of just forbidding the harmful bank credit. We could always do that, and then you don't need an active credit guidance. You just say, well, no, banks can't lend for consumption or asset transactions, full stop. That's enough actually on this topic of credit guidance. But there's an alternative, and one should combine that. Germany was not directly implicated in this, or not very much affected, in fact, by the 2008 crisis. And you look at how closely bank credit and nominal GDP growth were in line. So during that period, the 2000s, you did not have an asset bubble. They're working very hard to create that now, but that's another story. So why was that the case? Well, it has to do with small and medium-sized enterprises. And you will have heard this German word Mittelstand, which is medium-sized enterprises, family firms. Why do they matter so much, these small and medium-sized enterprises, SMEs? They do have a big impact. In aggregate, their total investment, capital expenditure, in most countries will be 20%, 30% of the total, so that's substantial. But even more importantly, they're the main employer. In the UK, they account for 65% of employment, which is a low figure for an industrialized country. In most other industrialized countries, 70%. Japan, up to 80% of all employment is accounted for by small and medium-sized enterprises. And of course, they have a job multiplier. They create more jobs. So if you give 100,000 euros to a small firm, and you compare that to the effect on job creation, giving the same 100,000 to a multinational corporation, maybe also based in Ireland and Dublin, which one is going to create more jobs? Well, this is the trouble with scale. When things get too large, they lose the human connection, and therefore it's very important to support small-scale activities and small-scale enterprises. Now, small firms are entirely dependent on bank credit. They can't really get access to capital markets. There's lots of talk and PR about private equity funds, venture capital, and angels and all that, but it's really a drop in the ocean. They're still dependent mainly on banks for funding. So how can we ensure that banks will fund SMEs, as they should, clearly, job creation, productive economy, less speculative lending, activities among small firms. So what structure of the banking sector has achieved something similar to the Asian window guidance without active guidance? What type of banks are prone to lend to large-scale financial speculators? Well, you can do an empirical examination, as we did, 15,000 US banks. It's the large banks. In fact, you can skip that and just use your common sense observation. There's a basic rule in banking, which we verified empirically using this very large US banking system with 15,000 banks. It's very consistent. Large banks lend large amounts of money to large borrowers. Likewise, who lends to small firms? Small banks. And that's been the recognized problem, recognized for a century in the UK. The big five don't lend to small firms. No, you'll never get them to lend to small firms. If you are Lloyds Bank with £1,000 billion balance sheet, you want to grow by 5%, you have shareholders, 5% is probably a modest target anyway, so your loan book needs to grow by 50 billion every year. So you've got a choice. You can give out £20,000 loans to 2.5 million small firms, family businesses. That would be good for the economy. Or you cut 50 checks to hedge funds and private equity financial speculating funds. They are borrowing $1 billion each from banks. In fact, more than that. And you're done. Which one are you going to do? Well, we know what the banks have chosen. So SMEs don't get the necessary funding from the banks. There's also insufficient funding for green economy and grassroots community-based initiatives. In fact, what's been happening with concentrated banking systems, so also Ireland, where there's effectively a small number of very large banks dominating banking. A lot of the deposits are taken from local communities and given to the money center, the big banks, eventually, where they're being lent for financial speculation. So really there's a drain of resources from the local communities, the capital extraction, which is of course harmful for local communities. So what's true in UK banking is, I'm sure, also true for Irish banking. The objectives of the banks, which essentially is the big banks and the communities, do not coincide. The centralization of bank operations, branch closures all across the UK. They don't want to deal with their customers actually. They just want to focus on their large-scale customers. They focus on unproductive financial lending because you can get the big numbers, the large scale, and you extract money from the regions. But the alternative is what we saw when I showed the number of banks in the EU. The largest number of banks is in Germany. There's 1,500, 1,600 community banks there, and they account for 70% of banking measured by deposits. These are the Sparkassen, local, public, semi-public banks here, 43% of deposits. And then we have 27% are local cooperative banks. They are, in Germany, they're full-blown banks. They do everything that banks do. You could call them credit unions, but, well, they operate as full-blown banks, but, you know, and locally. And they're all locally controlled. There's 70% of banking and not-for-profit. All the money stays in local communities, and of course they also pay taxes, unlike big banks that operate schemes not to pay taxes. So local banking, of course, is popular because local small firms get access to finance and at good rates. Depositors get competitive rates, and the community gets a bank that has the same goals, pays local taxes, pays taxes in general. You have job growth. Local banks also in Germany, they do many training schemes, apprenticeship schemes, which businesses benefit from tremendously. And depositors know, well, my money is going to benefit the local economy. Now, it's very powerful to set up a bank because with, you know, if you use the way the system operates for your benefit, you can have a big impact. So if you can raise, say, 20 million euros to set up in a local area a community bank, then within 3 years that bank can have 250 million euros in lending, and that will make a big impact. When I talk to local authorities in the UK who are supporting us in our project to set up community banks in England, they always think of the initial capital needed, you know, 15 million pounds, 16 million, as something, oh, so we have to put this in regularly, don't we? It's like an annual budget. No, just once. It's very hard to get them to understand. No, that's enough. That's it. You never have to put in any more money. Just once, you set it up, and then it becomes self-sustaining. In fact, it will, after a few years, pay you dividends if you get local authorities to be, shareholders. So this is money available for local communities. So the solution is a network of local, small-scale, not-for-profit community banks. We model it in England quite explicitly on the German example, which the City of London hates. So I mentioned it as much as I can. They've worked very hard in the City of London to keep community banking out of the UK for 200 years. As you can imagine, we have a lot of resistance from the city in our work. Of course, there's no speculative lending, mainly productive lending. And also, the structure needs to be designed so that you prevent takeovers of these banks. It's a tried and tested business model. This is really the true secret of German economic success the last 200 years. There have been wars, disasters, crises, aplenty in those 200 years, but the economy has fundamentally remained strong. Why is that? Well, because the small firms, which are the main employer, have been fully supported by the many, many local banks that lend only to the small firms in their local area. They're committed to local sustainable economic growth, and while they're not for profit, banking is profitable. You just need to make sure you keep those returns in the local community. There's no banker bonuses. Also in the community banks we're creating in England, why should there be bankers bonuses? There's just ordinary salaries for what should be actually an ordinary job. And of course the community needs to have a sense of ownership of these banks. So let me just quickly tell you how we're doing this in England. We've established Local First Community Interest Company with the goal to establish community banks. We're starting with the area where this group of supporters, where we're based in Hampshire. It's also where Southampton is. My university is also one of the supporters. The Hampshire Community Bank, which is due to launch next year, focuses on SME lending, lends productively. Local deposits are used for local economic growth. We have also a green part of the portfolio for the green economy, green growth program. And the idea is simply that this local banking will serve as an engine for local growth. Together, very similar to the Sparkassen model from the Sparkassen study for Ireland, there should be more of those banks, of course. Well, we had to start with one. And by having shared back office and shared IT, then we get additional scale economies. We're setting up Hampshire Community Bank, so we're not dependent on this, but it's likely to happen and will be an additional bonus, increasing the effectiveness of the bank, the community bank. We got some government money, seed money to start. We've already lent out to SMEs close to £1 million. You don't need a banking license for that. And in fact, if you do it correctly, perhaps you can avoid a banking license altogether, but that's another story, because remember, what's regulated is deposit taking, but there is no deposit taking. Everything is a loan. And of course, lending, trade credit, is unregulated. So if you structure it correctly, there's a lot you can do actually. But we're going for the banking license. It does make stakeholders happier, and it's probably the better way to expand this model in the long run. So we've raised 8 million in total so far. We want to raise another 8 million in the coming year. We started out by getting funding from publicly spirited investors on purpose to make sure it's clear to everyone this is for the public benefit. So we got the funding from local authorities and also the universities in the area, and they've supported this. Now we're raising the second half of the money from other investors. There's some insurance companies whose corporate social responsibility programs are quite interested. We're talking to various other investors, but all these investors can only get half of the bank for those shares. The other half is owned by a charitable foundation, which has in its constitution that this ownership, majority ownership of the community bank, is inalienable, can't be sold off. And the idea is that this will always serve as a way to prevent takeovers, but also to ensure that the benefits of the community bank are going to be with the local community. The charity will hand out half of the profits of the bank for charitable purposes in the local community. This seemed quite useful and suitable for the legal environment in the UK, because in Germany, the Sparkassen, they have their own laws. Of course, if you want to go down that route, it'll take years to pass laws to establish a similar system. The Volksbanken, Raiffeisen, People's Banks, cooperative banks, they also have laws that establish this whole system of cooperatives, and it's in Germany has a long tradition. And it's a fact in the UK the regulators have never given a banking license to a cooperative, and to try to be the first one could also mean further delay. So we thought with this structure we get the benefits of the German model for the sort of for the UK legal environment. So there's many benefits. I think we've mentioned this. Let me just talk and try to round off the presentation by talking about a few different angles now. So what about the idea that we centralize money creation allocation and give more power to central banks, as a lot of campaigns, including Positive Money, are arguing? Central banks have, as I mentioned, have a lousy track record. They have not created money for the public good for, well, maybe not ever, in some countries in the past, but certainly globally not for many decades. Over the last 40 years alone, we've had over 100 banking crises, almost all ultimately caused by central banks that have the know-how, the data, the information, and all the tools to prevent this, but they've never prevented it. So the ECB oversaw the creation of these bubbles in Ireland, Portugal, Spain, and Greece, while it's at the same time the most powerful central bank in the world. It could do anything. You know, if you look at its statutes, there's no government that can tell the ECB what to do and what not to do. And yet, this is the result, this is the fruits of its labors. Inevitably, taxpayers have been forced to bail out banks. That's entirely unnecessary, and again shows that the central banks are not out for the public good. Why ask taxpayers to bail out banks? Okay, let's say we've agreed we should bail out banks. Obviously, that's a big if, and we may need, well, maybe we shouldn't agree to it, but let's just take that as a starting point. Okay, for some reason we think we need to bail out banks. There are different options, and using the taxpayer money, public money for this, is the worst of all these options. So it's shocking that this is the one they're always going for. Let me just go to this, actually. So it was the ECB that forced the Irish government to bail out the banks, and therefore Ireland moved from being fiscal poster boy to being bankrupt and having to call the IMF in. That was an ECB policy. The ECB could have allowed its offshoot in Ireland, the Irish Central Bank, to solve the problem at zero cost to the taxpayer. All you need to do is for the central bank to purchase the non-performing assets of the banks, move them on the central bank balance sheet, then the problem is solved. Because what is a banking crisis? Well, there's an accounting problem with the rigged accounts of the banks. We know they're rigged anyway, and so there's a bit more rigging. And you can simply change the numbers, and the problem is solved. Why should people be unemployed for this? For some bookkeeping problem? Well, don't worry, I'm not advocating to fiddle the books. You can use current accounting rules to solve the problem at zero cost to society. Let me just try to get this. If we look at Japan in the 90s, where the banks were bust and then disaster upon disaster happened, it started with a banking crisis. Well, there was actually a bigger banking crisis in Japan in 1945. The banks were 100% bankrupt. In 1990, 1992, 1993, they were only 25% bankrupt. And 25% of the balance sheet was non-performing. As we said, that's of course more than enough to bust the banks because they only have 10% equity or less than 10%. But in 1945, 100% of assets were non-performing. Also, in 1945, companies were 100% dependent on banks for funding, whereas in Japan in the 1990s, only 50% or less than 50% of funding came from banks. Capital markets have been growing and expanded. So, in which situation would you expect a longer recession as a result of the banking crisis? The 1990s or 1945, the end of the war? Well, it should have been after 1945. But actually, there was only a 2-year recession. Banks already created credit at very fast pace from 1947 for productive purposes. What happened? Well, the central bank bought the non-performing assets from the banks at face value, and therefore moved them off the bank balance sheet to the central bank balance sheet. And the problem is solved. And the central bank doesn't even make a loss. Let's say it buys those non-performing assets, which are worth only 20, it buys them for 100. So it looks like the central bank is going to have a loss of 80, but the reality is it has a gain of 20. It gets something that's worth 20. What did it cost the central bank? Well, nothing. It's a central bank. If you had a license to print money, it wouldn't matter so much to you if you bought something slightly over the odds, slightly more expensive than it should be. Is this going to lead to inflation? Would this lead to inflation? No, it doesn't lead to inflation, because no money is created, actually. Money is created when the banks and the central bank create money injected into the non-banking sector. But with this transaction, no money is injected into the non-banking sector. It's just a rebooking between banks and the central bank. It's just, cleaning up the accounts. So no money is injected into the non-banking sector. It's impossible to create inflation with this. This is evidenced by the Federal Reserve, which did this in 2008. That explains why in the US, despite the fact that the 2008 crisis started in the US, and that was where the crisis was most significant in many respects. Despite that, banks have been lending already since 2011 at very fast pace, 4-5% bank credit growth, whereas in Europe, Ireland, Portugal, Spain, Greece, minus 10% and so on, for years and years, still ongoing. So the reason is the Federal Reserve did just that, did what the Bank of Japan did in 1945. It bought non-performing assets off the banks, off the balance sheet. So its own balance sheet quadrupled. So a lot of people thought, well, the dollar is going to collapse. Well, it didn't. It rose. Why? It doesn't create money. That's misleading. It's just, central bank balance sheets, you have to know how to read them, because central banks, of course, can manipulate the balance sheets at will. And this transaction doesn't actually inject real money into the economy. So why should there be inflation? There wasn't any. Why should there be a weaker dollar strengthen? Of course, the central bank that pioneered this was the Bank of England, the pioneer of central banks, most of its history privately owned. And the Bank of England did this in August 1914. What happened in August 1914? The United Kingdom of Great Britain and Ireland declared war on Germany and her allies. It turned out that the city hadn't thought this through, and several big banks in the city of London were bankrupt immediately. Why? Well, Germany, the Austrian-Hungarian Empire, all these imperial states, and also the Ottoman Empire, and they were allies. They were doing a lot of their trade, international trade and finance, through the world's financial center, London. So London banks held a lot of their bills and notes, and all that, of course, had to be deemed in default, because you could not legally now claim that money because it was a state of war. So several banks were bankrupt, and the Bank of England thought it's not a good moment to have a banking crisis and have large-scale unemployment. So no, we're not going to have that. Therefore, we'll just solve the problem at zero cost to anyone, more or less overnight, by buying those non-performing assets. Not in market value, but something close to face value, problem solved. So if central banks want to avoid recessions emerging from central banks, then they know how to do it. But this is not what the ECB did. The ECB insists that the Irish government, the taxpayer, Irish people, come up with the money to bail out these big banks. Because as you know, in Iceland, people had a revolt against this and refused to bail out the banks. And what happened? Well, they did quite well. So this is something that makes me very cautious, to put it mildly, about the idea to give more power to central banks in concentrating this allocation decision. Now, the other point I want to make is, what about other activities of the ECB? Currently, the ECB is engaged in a war to destroy the 1,500, 1,600 community banks in Germany and also Austria and other countries where there's also still a few left. Why is that? Why am I saying this? Well, number one, since 2008, the EU massively increased bank regulation and the burden of bank regulation. Almost every year there's a 600, 800-page new document coming out that all the banks have to implement, which is pretty incredible a task facing a small community bank with maybe 10 staff or 15 staff. They just don't have the resources. They have to hire full-time staff now in this new reporting requirement, handing in regular reports and this, that, and the other, because the EU makes no distinction between the big banks and the small banks. If you go to the US, where you have all bank sizes and also a lot of small banks, the small banks get their own regulator. And the regulatory burden is very light because they're small. It's very reasonable and sensible. But the EU is using the same rules for the world's largest banks as it's using for a German community bank with 10 staff. Can you believe it? So they have to close. And this is what's currently happening. So in the next 5 years, there won't be 1,600. We're lucky if there'll be 600. The other way they're killing them is the interest rate policy of the ECB. So it lowered the short-term interest rate to 0, and it's pushing the long-term interest rates, it's been pushing them to 0 through its purchase program, asset purchase program, which is just making the speculators richer but doesn't help the economy. So you've got a 0 interest rate and a flat yield curve. Now, productive lending by the good banks lending for productive purposes really works when you have a bit of a positive yield curve. Short-term interest rates are lower, long-term interest rates are higher, which is the normal situation. But now we've got a flat yield curve at 0. So banks that lend for productive purposes are the ones that are killed by this. They can't survive. They're actually now forced to do what the big banks are doing. They don't mind this because they use the money for speculation anyway. And when you do this QE, purchasing assets, pushing down interest rates, you are fueling another asset bubble that the big banks are happy to speculate in, which is what's happening. Now they're forcing also community banks to move into asset lending because otherwise they have to close quicker. So they're creating a property bubble in Germany through this policy, but they are forcing the community banks to merge. So there's a merger mania now happening under this pressure, and this is their way of destroying these banks before other countries introduce the system. The central banks are also currently waging a war on cash. They've been introducing negative interest rates in a number of countries, and they argue that that's good because with interest rates we can stimulate the economy. If 0 rates are not enough, well, we have negative rates to stimulate the economy because lower rates lead to higher growth. Well, this has never been true. This claim that lower rates result in higher growth. Firstly, about negative rates. Negative rates are imposed by central banks in several countries now, such as Switzerland and Denmark, on banks. So it's for these reserves held by banks at the central bank. They say now you have to pay a fee, essentially. It's like a tax on the banks. And what are banks going to do? They're less profitable. They're going to pass it on to their customers. And we've seen this in Switzerland very clearly. Since they introduced negative interest rates to allegedly stimulate the economy, borrowing rates, interest rates that have to be paid by borrowers, have been rising. So it's strange that central banks insist on this policy. But there's a second reason why this has always been nonsense, because there's no evidence that lower interest rates stimulate the economy at any time. Lower rates do not stimulate the economy. Likewise, higher rates do not slow an economy. This idea that the price of money is a key macroeconomic tool and that lower rates lead to higher growth, higher rates lead to lower growth, is actually one of the central tenets in modern macroeconomics. And it's been repeated so many times that most people think, well, surely that's been tested, proven hundreds of times, thousands of times in all sorts of studies. But no, There is no evidence for this claim whatsoever. If you look at the data, what you find is that you've got interest rates on the vertical axis and nominal GDP growth on the horizontal. There's a positive correlation. So more growth goes hand in hand with higher interest rates. Japanese data, you can use US data, more growth, higher interest rates. Look at the leads and lags. Which one comes first? The official story is rates happen first, they move the economy. The economy follows on the action of the rates. Well, the empirical evidence shows the statistical causation, the timing, is the other way around. So look at Japan. The pink line here is nominal GDP. It started to rise significantly in 87. It took 2 years for interest rates to rise. Then GDP fell and interest rates follow. This is true also for the US. This is now bond yields. Even the most liquid securities market in the world, the US Treasury market, shows that it follows the economy. Interest rates follow the economy. So first GDP decelerates, growth falls. Then with a big time lag, almost a year, interest rates fall. GDP rises, then interest rates rise, then GDP decelerates again, then interest rates fall. So the official story that high rates lead to low growth and low rates lead to high growth is contradicted by reality. It's the other way around in 2 dimensions. High growth leads to high rates, low growth leads to low interest rates. That, of course, raises the question, well, if rates are not what's driving the economy, what is it? Well, you know the answer to that. It's not the price of money, it's the quantity of money. And what is money? It's bank credit. That's what's driving the economy. Bank credit for GDP transactions, and you can show this statistically, very clearly drives nominal GDP. So why do central bankers keep repeating the mantra that they use interest rates as policy tool? It cannot possibly be a policy tool because it follows the economy. Next time they lower rates, it's because they've ensured through their credit policies that the economy is going down, and rates follow that. That's all. Essentially, interest rates are to distract you and to confuse people and hide the truth of how the economy operates and what central banks are doing. Because with interest rates, they will always try to argue, look, we're working really hard to create a recovery. The Bank of Japan for over 20 years has tried very hard to get a recovery. Well, it just didn't work. Tough, isn't it? Well, no, they have not tried hard at all. It's been the Bank of Japan that has prolonged the recession, and that's what central banks do. And that's why we have to be very careful about giving any more power to central banks. We have to do the opposite, take power away from central banks. You see this, and this is my last point, in the current central bank war on cash that's going on. Why are central banks adopting the policy of negative rates? Since negative rates cannot cause an economic recovery, they actually raise borrowing rates, as we saw, and they hurt banks, they kill community banks, therefore you get less SME lending. It's just totally the opposite. Central bankers have at the same time been reflating asset bubbles, helping the big banks and financial speculators. So you clearly see whose side they're on. And of course, historically, all central banks have been, in the past, if you go back to before the Second World War, all central banks had been created by banks, by the big banks. Big banking groups created the central banks. They're their creature. And it seems that even the ECB, which is a much more recent construct, is fully captured by big banks. I mean, you've got a Goldman Sachs guy hitting it. Now, the central banks argue that, with this, so they just insist, interest rates will stimulate the economy. That's why we're trying to have negative rates. And to make this work, we need to abolish cash. Why? Well, because of course people, because with negative rates, ultimately they'll ask us to pay fines, and they just reduce the money in our deposit accounts, right? Negative rates. But of course, if that happens, people will withdraw their money and move into cash. obviously. Therefore, cash should be abolished. That is the convoluted logic. Now that is one of the goals. And so they're even willing to adopt this nonsensical negative interest rate just so that they can have a reason to argue we need to abolish cash. You see? Because that would then leave the central banks completely in control. Digital cash, centrally controlled by the central banks. We are talking about a totalitarian regime here. And this would be the culmination of the 20th century agenda to centralize power, in ever more power in the hands of fewer and fewer, which clearly has not been good for people anywhere. What we need to do is the opposite and work against this trend towards a decentralization in general of all systems, but clearly the monetary system and banking is at the core of the problems, and therefore we need to introduce a decentralized banking system. And to me that means, well, community banks controlled by local communities, because then they're also accountable. As soon as an organization gets too large, it's very hard to make it accountable. And as something as important as money creation therefore needs to be broken up into many small community banks. They are accountable to local communities, and you can keep a tab on that. And we see this when we have a community banking system with many small banks with only 2 directors and 10 staff. They can't do anything without everyone in the local communities knowing what's going on. And so they are accountable, and then you get sensible lending for projects that people want. And the bankers in these community banks know, well, we can't do that because everyone's going to hate it. And so they're not going to do these horrible projects which the big banks love to implement. There's much more in some of my books. The Princes of the Yen is also out as a documentary on YouTube, so you can watch it freely. If you just go to YouTube and put in Princes of the Yen movie, you'll see it. This is particularly about this theme of the dangers of the centralization of power in the hands of the central banks. I've got a few more things, but I'm afraid I'm already totally running over here. Perhaps just one sentence, if I'm allowed. I tried to get the Irish Finance Department to adopt this policy to stimulate the Irish economy by doing something very, very simple. No extra money, not even the central bank needed for this. Something the Finance Department can do. Perhaps you can all demand this from the Irish government. They need to stop the issuance of government bonds and instead borrow from banks in Ireland. Then you get bank credit creation for GDP transactions. Of course, it's a stopgap measure, but it will boost nominal GDP and employment, because what they're currently doing is they are just helping the big banks, which are bond underwriters, by issuing bonds, but that crowds out the private sector, essentially. So this is a policy that could be implemented in Ireland, Portugal, Spain, Greece. Bank loan contracts are non-tradable, and therefore they beat bonds as an instrument funding, also in terms of attractiveness for banks. The sovereign debt crisis, which has been a big problem in Spain, Portugal, Greece, can be solved very easily if governments didn't borrow through bonds at all, but borrowed from banks, namely the money creators. Bonds don't create money. If you look at just the data, the interest rates on the bonds have been much higher, of course, than interest rates from banks. So the Greek government had bond yields between 20% and 60%, but they could have borrowed instead from the banks, which create the money and therefore expand the money supply, at less than 4%. But they didn't. Isn't that funny? Ireland, so in 2011, the bond yields were 12%, and the government raised money at 12%, while at the same time, the interest rate charged by banks for their best customers, which the government would be, even in that situation, was less than 4%. But they didn't do it. You see, because they're in the pockets of the big banks and the bond underwriters. So there's many things we need to push for, but I've already taken a lot of your time. So thank you very much.
Thank you.
Right. I will talk about how to make banks socially useful, and I'll make the case for local banking. And as by now I think you realize this also means local money. Lord Adair Turner has been cited before, and he's one of the, I think, great supporters of new and interesting thinking on these topics. And he has said on the record that he feels currently in the UK the banks are not socially useful. That is quite a radical thing to say for the chairman of the FSA, the regulator of the banking sector. So that raises these questions. Well, what makes banks socially useful? What's the right size? He was saying they're too big to be socially useful. So the issue of size was raised, and there's been a debate about banks being too big. What are the arguments behind that? What are the effects of size in banking? And so how can we reform the banking sector to make it contribute better to society? Well, of course, no need to reiterate, and for the sake of lack of time, we're aware of the shortcomings of the UK banking sector, the link to boom-bust cycles, crises, the focus we've heard already today and also yesterday on large-scale financial sector lending as opposed to other lending of the type Triodos Bank, for example, is doing. So there's a bias among the large banks against that and focusing on financial speculation. And of course, also very much in the media, the lack of bank lending to small firms, the local regional economy, and sustainable development. So what do banks do? What is their key function? Well, we've had this question in the earlier session. How does this link into what mainstream economists are saying? And you've already heard an alternative view of what banks are doing. And there seems to be very little resonance in mainstream economics of this representation, what I think are the facts of banking. So just in response to that and recap, this is how banking is represented in textbooks. Banks collect savings. Savers are ultimately the ones that have the money, and they can put them with the banks as deposits. There's a reserve requirement in many countries. In the UK currently, over time it's been reduced. In the UK it's zero now, which somewhat weakens the mainstream textbook argument. It's still in the textbooks. Actually, I must say, it's in those textbooks that still have money and banks in them, because, of course, there are many mainstream textbooks, particularly at the master's level and PhD level, that don't have banks, and then they don't even have money in them. So these are sort of the better textbooks that have something on banking. So there's a reserve requirement, say 1%. That's realistic for those countries that have a reserve requirement. And so if a bank receives £100 in new deposits from the savers, it gives £1 to the central bank, and £99 are then lent out by the bank. And so the banks are intermediaries taking the money in and handing out, whereas, as was also another question earlier on that hadn't been answered, so I'll do the answering part of this. What about direct finance by companies when they issue bonds? This is considered so-called direct financing. Because companies, the ultimate borrowers, investors that put money to use, so we're told in the textbooks, they can issue bonds, and the savers can buy these, say, corporate bonds. I mean, as we all know, we frequently buy corporate bonds. When's the last time you bought a corporate bond? But anyway, it doesn't have to be retail purchases, of course, so let's grant them this simplification. So this is called direct financing. The banks are the indirect finance sector. And then over the last 20 years, this paradigm that actually banks are just intermediaries, in fact, cumbersome, old-fashioned intermediaries, has been pushed also on other countries, many developing countries, emerging markets, and also in Asia, even the very successful economies in East Asia. So when the Asian crisis happened, we had leaders, world leaders in sort of economic decision-making, the chairman of the Federal Reserve,
the US Treasury Secretary, Undersecretaries of State, and making a whole number of claims that this crisis is due to the Asian countries relying too much on banks as opposed to direct financing in the stock market or corporate bond market. Banks as such are always unstable and unreliable. Of course, there's a lot of truth in this claim. So the solution is, it was said, and also yesterday we had a member of the MPC at the Bank of England basically arguing along those lines, to go more for direct finance, securitization, offer for small firms the ability to borrow directly by issuing bonds, and basically not use banks. And of course, there was the argument, particularly popular emerging from America, that we need more sophisticated financial products, derivatives, credit derivatives. Even what the banks are doing can be securitized and sold off. The CDS, CDO derivatives that by now have become a household name because of their involvement in the crisis. And this sort of system that relies less on banks will deliver more growth and more stability, we were told. And of course, it was an attractive sort of system that was offered particularly by American banks. There was an extension of credit that later turned out to be toxic waste, which was transferred into AAA rated assets, and the banks made a lot of profit, but it didn't quite work out in the end. Now, the mainstream economists couldn't really handle it. So when they had the crisis and the journalists were calling them, say, professor of macroeconomics at MIT or Harvard, and they were asked, well, can you comment on this banking crisis? Lehman's just gone bust. If they were honest, they would have said, I'm sorry, no. My economic theories don't include banks. I suspect they may have been fudging that point. But we have a lot of mainstream economists on the record now saying things like, there's been a problem. Banks have been excluded. This is the vice chairman of the Fed, Donald Korn, saying that the problem has been that central banks, and this is what a lot of academic economists look at for guidance to how they should research, central banks, they're supposed to be the experts on the monetary sector, have economic models with only a limited role for credit provision and financial intermediation. And that is, of course, central bank understatement, no role for banks. And this whole issue of credit supply and the link to asset prices and economic activity was not well captured in those models, wasn't part of those models. So there is an increasing recognition, and that's the good thing of this banking crisis. Empirically, even in the mainstream economic literature, it has been clear that there's been an anomaly, a problem, because empirically banks can be shown and have been shown to be special in some ways. They have some kind of monopoly power, which you can show empirically using data, as, say, Farmer, a mainstream neoclassical economist, has done. Ashcraft, Federal Reserve staffer, has shown, for example, when small regional banks go bust, the economy suffers, which is quite obvious to everyone, but that shows that there is something that can't be replaced easily. So why is that? And of course, you've heard the answer, but now just to pose this in comparison to the mainstream story, where we have a new deposit of £100 with the bank, and we're told it gives then £1 to the central banker's reserve, and it lends £99. It's just not true. You see, the methodology used in mainstream is the deductive methodology, which doesn't start out with looking at reality and facts. It says, oh, we have axioms. Axioms are things that we know to be true. And they're so true, and we know them so much to be true, that we never have to check whether they're actually true. And by the way, they're not true. And then we add assumptions to this. And assumptions are things that from the outset we know are not true, but what the heck, let's just build a model based on them. So this construct would not come up with the idea of how reality works, because reality is just so quirky. And a logical deduction from first principles wouldn't deliver the banking system that we have. So it wouldn't occur to economists. What actually happens is when you have a new deposit of £100 with a bank, is that, and we have a reserve requirement of 1%, for sake of argument, not £1 is given to the central bank, but the entire 100 deposit. And the bank then says, well, that's my 1% reserve. All right, and so we've got the new deposit, £100, and immediately the deposit with the central bank, double entry booking, as Josh pointed out. So how much can the bank now lend? If the 100 is the 1% of 10,000, minus the 100 given to the central bank, means 9,900. And how's this done? The moment you get to your loan contract signed, the moment you sign, the bank can put this on the asset side as an asset, and then it has to invent the liability for the balance sheet to balance. Well, you will ask, can I please have the money? I don't care about the accounting. And the bank will say, we've just put it into your account. They may even say erroneously, we've transferred it into your account. There's no transfer. They just write the figure. Somebody types it in. So this is how it actually works. And the reason why this is not recognized is the fundamental flaw in the methodology in economics. And this is why, of course, talking about this and educating economists is very important. There is no such thing as a bank loan. There is only bank credit creation. So this is what makes banks special. And so the majority of the money supply is created by the banking system. Schumpeter already pointed out, 1954 was posthumously published, it's proved extraordinarily difficult for economists to recognize that bank loans create deposits because of their flawed methodology, the deductive methodology. So they're not intermediaries. In fact, the whole concept of indirect finance versus direct finance is wrong. And so when the question was raised, can't we just have bonds and corporate bonds? What about those? Or what Adam Posen said yesterday, shouldn't we have just issuance of debt securities for small firms and enable them to raise money that way? Well, of course, that can help in individual cases. But we know for the whole economy, this can't replace the monetary system that we have, because to have what we call growth within the standard definitions, and they're clearly limited, and there's many problems with the concept of GDP, but within the system, to have GDP growth, you must have growth in the money supply. And the system is designed such that this is only possible if we have bank credit creation. So the banking sector, including the central bank, and the banks are the vast majority, have to create the money supply. And banks are not financial intermediaries, they're the creators of the money supply. And so the difference to bond finance, securities finance, is that doesn't create money. So it's a transfer of existing purchasing power. This is also the problem with the idea of local currencies. The way it's currently being done is that of course, there's a one-to-one exchange rate to the pound. And so they're not quite the same. They're a substitute. They may attract transactions to the region, but that's shifted away from other parts of the economy, which may still be very useful, but it can't substitute for what we require for growth in the current system, and that is money creation. Now, the credit creation, the money creation system can be divided into transactions that are good, if you want, that contribute to GDP and investment and sustainable growth, and transactions that don't even contribute to GDP and are not sustainable. The bad ones shown in red here. So credit for financial circulation, credit for real transactions is total credit, and that determines growth. So GDP growth, nominal GDP growth, is a function of credit for GDP transactions. And this explains in this debate among economists the many puzzles that exist with the standard macroeconomic models that they can't explain because they don't have credit creation in their theories. So there's three cases. We can have growth without inflation, the good scenario, the green scenario, productive credit creation, when the banks create credit, give a loan for the creation of new goods and services and increases in productivity. That's non-inflationary. Because this is the first worry once you start about money creation. Is, well, isn't it going to create inflation? Well, if we have productive activities funded with new money creation, we've got more money but more goods and services, no inflation. If we create credit for consumption, we've got more goods and services, the same amount of sorry, we don't have more goods and services, but more money, we must have consumer price inflation. And you can show this empirically, how nominal GDP is explained by credit for GDP transactions. And of course, when credit is used for financial transactions, we must have asset bubbles, and they are essentially the same. Adam Posen was making the case yesterday that housing is different somehow, and of course for individuals in the housing sector it is different, but macroeconomically the mechanism is the same. So credit for property transactions explains property prices up and down the cycles. This is Japanese data because the Japanese macro data has been the biggest puzzle of all in macroeconomics, and for the longest time period, for decades. And so if there's an alternative theory and it can explain the Japanese case, I think that's the strongest argument in its favor. So when credit for financial transactions rises as a share of total credit, and when total credit growth is ahead of GDP growth, you know you're creating a bubble. And this can be outside the housing market, like in the US in the 20s. As Anne also pointed out, and as I pointed out yesterday, Adam was making the case that it's mainly housing, but it can be stocks, and that can have a devastating impact on the economy, resulting in, when the bubble bursts, unemployment and many problems. In the UK, credit for financial circulation has grown vastly faster than GDP. And so it was clear that that was an unsustainable bubble. It's always unsustainable in macroeconomic terms. So this is a warning signal. If you look at Europe, and you've wondered, so what's the story then? Ireland, Spain, Greece, all that. Well, it's the same story. When broad credit grows faster than nominal GDP, you're creating a bubble that's unsustainable. And of course, when that bursts, you have your crisis. Spain, credit growth was 20-25% for many years. Whereas if in Germany, as a counterexample, as in Germany, credit growth is in line with GDP growth, then you don't have an asset bubble, which is what happened there. And unfortunately, in the UK, bank asset to GDP ratio is one of the highest in Europe, in the world, in fact. Now, credit creation is a public privilege, and we can organize the economy and the system differently. This privilege has been granted on the implicit understanding that banks won't misuse it or use it against the public that granted it. But because the public has forgotten or was never aware about this, there hasn't been any checks and balances. Regulators haven't even asked banks to use their power to create and allocate money and reshape the economic landscape wisely, i.e. lend for productive purposes. That's what we need. We need an intervention. We need regulation that encourages or forces banks to lend only for productive purposes, defined here obviously as sustainable as well, environmentally sustainable. Otherwise, how can it be truly productive? So as a result, banks, and here I think you really can't blame the bankers, have done what the incentive structure tells them to do, create credit for where they get the biggest profits, financial speculation. So the policy recommendation and the agenda for reform is, number one, we need to have direct intervention in the core driving causal factor here, and that is credit creation. And fortunately, there is a long empirical history of credit controls or credit guidance, a somewhat more acceptable expression. Many countries have used it, and it's in fact the only form of bank regulation that has an empirical track record of working and doing the job. The tool can be used for bad results when you set bad goals, as happened in Japan in the 80s and 90s. But the tool worked extremely efficiently. And of course, this has been used in the UK. It's known as the corset, but was deregulated away in the 1970s. But many, many countries have used it, and particularly in East Asia, it's been at the core of the East Asian economic miracle. Shouldn't we look at countries that have grown so successfully, if not, unfortunately, entirely environmentally friendly, but that's something that can also be changed. The tool is neutral in that question, and that's been credit guidance, or window guidance as it's called in China, Japan, and Korea, at the core of their fast growth stories. So what are the policy lessons? How to avoid the crises? Well, restrict credit to financial speculation. You don't need the other policies. And you can have a different type of banking sector. Look at Germany. If you look at the percentage shares of different types of banks, you see that what in the UK are the high street banks, 6 banks accounting for 90% of banking. In Germany, they're 13%. That's it. This is Commerzbank, Deutsche Bank type of banks. 70% is small local banks. And that's why in Germany, even without direct credit guidance and credit controls, there hasn't been an asset bubble. Because these local banks, credit unions, cooperative banks with headquarters locally, hence my question to Triodos, the local loan officers making the decisions, they're not interested in large-scale financial speculative loans. They want to lend to local businesses, and that's almost always by definition more productive. And so in the UK, we've got this puzzle. There are actually financial institutions that don't have big bonuses, that don't lend for speculation, that offer simple products, and they're interested in individuals, small firms. They're the credit unions, but they're less than 1% of the banking sector, whereas in Germany they're 30%. Why is that? Legislation, quantitative restrictions, largely due, I believe, to the banking lobby, because of the banks being very influential in funding political parties. So we need further reform of the laws. It's a law that credit unions are so restricted. And it's not justifiable. Many countries, even Ireland, the US, have bigger chunks of credit unions as part of the banking sector. So to summarize and end my presentation, since I'm out of time, the first reform proposal is to end the suppression and repression of the third sector, the mutual, cooperative, credit union sector, and introduce hundreds, if not thousands, why not, of cooperative, mutually, locally owned, municipality, city-owned credit unions and banks. That will already solve many problems and is not costly to do. Secondly, introduce a regime of credit guidance. That doesn't cost anything, can be done top-down through the Bank of England, will have immediate impact and deliver immediate results. These are the two modest reform proposals because you can do it almost overnight at almost no cost and get results. You can go beyond that, and you should think and do go beyond that. Return the power to create and allocate money to the people because this privilege belongs to the people. Introduce state money, and Ben Dyson has made an eloquent pitch for that. This has all the advantages, what I've earlier said, without the remaining disadvantages, the seigniorage loss of private money. But of course, by having local banks, we can, these are just examples of state money, it has been done, state of Guernsey, the UK, the US. But by having local banks, we have our local currency because banks create money. So that's something we can perhaps do first of all. Ultimately, we should devolve controls to local communities and have true regional local currencies. Why not? State money on the local level. There's also empirical precedents. All these have historical examples that work very well. In the 1930s, the so-called miracle of Wörgl, the small town in Austria, that just started to print money at a time of 30-40% unemployment. And they almost moved to full employment. That's when the central bank moved in, and they almost got arrested, and it was abolished, and they went back into unemployment. So think about these things. Thank you very much.
It's a pleasure to be here. Thank you for the invitation. I would like to go straight into my presentation about the source of money creation and its allocation. And the underlying issue is central planning versus decentralized decision-making. Now, banking actually has not been very well understood. There have been 3 theories of banking, and they've existed and coexisted for at least the past century. The most dominant one currently is still the financial intermediation theory of banking. And nobody had ever done an empirical test. So I thought, well, since these theories are mutually contradicting, when it comes to the crucial question of where does the money come from when you get a loan from the bank? Well, let's figure it out. Let's do an empirical test. So I did this and published 2014 and 2016 two papers. The conclusion is the financial intermediation theory was rejected. Banks are not financial intermediaries. You may have heard of the fractional reserve theory, slightly older. That one was also rejected. It says that banks lend money out of reserves, and they don't. Financial intermediation theory says they lend out of other people's deposits, and they don't. So the oldest theory was the one that was found to be correct, and that's the credit creation theory, which was known 100 years ago, which is why one of the papers is called Lost Century in Economics. Banks create money out of nothing through the process of credit creation. I know there's some lawyers and experienced lawyers in the room, and actually the law helps a lot to understand banking, because at law, it's very clear, banks are essentially the opposite of what economists have claimed. Economists always say banks are deposit-taking institutions that lend money. Banks don't take deposits, and they don't lend money. They don't take deposits because they borrow from the public. A deposit suggests something held in custody, a bailment, and this is not what happens. Instead, the money that you lend to the bank, which they call erroneously a deposit, is actually their money. They own it. It's just a loan. You're a general creditor. And banks never lend money because, and that's unlike firms and non-bank financial institutions, they are in the business of purchasing securities. When you get a loan, the loan contract is a promissory note, just like the Bank of England promissory note, of course, not legal tender, as you may have noticed, but the bank will purchase that security from you. That's what it does. And now it owes you money, and it creates a record of the money it owes, which we call deposits. And that's how the money supply comes about. So you get a loan, £1,000, let's say. The loan contract is purchased by the bank. It increases the bank's assets, and the bank then records the money it owes you, which it calls, slightly incorrectly, a customer deposit, because no customer has deposited this, and in fact, nobody has deposited this anywhere. It's not transferred from anywhere inside or outside the bank. It's created out of nothing. These fictitious deposits are our money supply. So banks are special. They create the money supply, 97% in most countries of the money supply out of nothing through the process of what's called credit creation. That's, of course, also why, actually, central banks have been all along monitoring bank credit quite carefully, whether they announce this or not, and they've been guiding bank credit. And, of course, central bankers have been quite aware of these facts. Now, the recognition of bank credit creation is a game changer to solve many of the world's problems, such as the recurring banking crises can be prevented, unemployment can be solved, business cycles, underdevelopment, depletion of finite resources. All these problems can be solved by utilizing the power of bank credit creation. And this is something we'd think about before we decide to abolish it, because this power can be harnessed. So can we achieve high, sustainable, stable growth and development without crises? Yes. This is the fundamental basics. This is how the economy really works. So the money supply is actually credit, let's call it C, and we have to disaggregate it, because the crucial thing is who gets the money for what purpose. Simple disaggregation into the real economy, CR, and the financial transactions, financial economy, CF. So if banks create credit, it's used for financial transactions, the left side. This is, of course, one example of unproductive credit creation. You're pushing up asset prices. This explains in aggregate asset bubbles and all the large asset movements. It's simply credit creation for asset transactions. That's not part of GDP, because GDP is value added. And of course, that doesn't add value, it's a zero-sum game. But it will create banking crises, because once you've pushed up asset prices by 300-400%, they just need to drop by 10%, and the banking system is bust because equity is less than 10%. Now, when banks create credit for the real economy, for real transactions, we still have two scenarios. One is easily understood. If they create credit for consumption, you suddenly have more demand for consumer goods. And if they do a lot of that, of course, you get consumer price inflation. That's what most people think of as the central scenario. Well, it's actually only one of three. and the one that we understand best, and really not the most burning one, because it's been financial credit. But there's a third scenario, and that's when banks create credit for the real economy, but it's used for business investment in the creation of new goods and services, productive investment or implementation of new technologies. That creates growth without inflation and without crises. And as long as you ensure that bank credit creation is used for the green box, you get high growth, no crises, and no problems. So why haven't the central planners at the central banks ensured that? Well, they have in some countries, but not in others. And I think that's really the first issue we have to address. There's more to this, and of course in the 12 minutes I won't have time to address this, but if you split this credit creation, you can explain GDP growth very nicely in many countries, asset prices. Japanese asset bubble is just credit creation for asset transactions. When this doubled from 15 to 30% of total credit, that was the 1980s bubble, and Japan is still trying to get over that. So total bank credit in Japan was expanding at massive growth rates, way ahead of nominal GDP, going into asset markets. You didn't have to be a rocket scientist to know that a banking crisis was coming next. So the wrong allocation of money creation for asset purchases, that is the problem, and we need instead productive loans for business investment. So the key question is, who should make this decision? It seems the regulators, the central banks, actually had forgotten to tell the banks, oh, by the way, you should only create productive credit for sustainable business investment. That way we could have prevented all these boom-bust cycles and crises and all the inequality that's been created as a result of this. So now that we've uncovered this, what should we do? Who should make this decision? So the question is not really banks versus central banks. Should we take the privilege to create money from the banks and give it to the central banks? It's really centralization versus decentralization. Should this decision be made by central planners or in a decentralized market-based fashion? What's the scientific way to tackle this? Well, let's look at the empirical evidence. Let's look at the historical record. So what's the evidence on centralized decision-making? The idea to abolish bank credit creation and centralize the decision of the quantity and allocation of the money supply in the hands of one group of central planners is not a new one. That's how the Soviet Union ran its economy for half a century. That failed spectacularly. So let's keep that in mind. China, by the way, learned the lesson. Deng Xiaoping, from '82 onwards, changed its financial system and introduced banks, introduced decentralization with hundreds, if not thousands, of banks creating credit locally and making that decision locally. And of course, China thrived, and the economic miracle of double-digit growth was based on that. In fact, it used window guidance of bank credit to suppress, in a high-growth phase, the financial credit and the speculative and the consumption credit. Another example, evidence of centralized decision-making, the UK. Now, the UK has a very centralized and concentrated financial system because just 5 banks who, as we know, collude in many ways and fix things, make all the decisions. 90% of deposits are with them. So centralized decision-making in the London headquarters has not delivered very good results. By the way, there's reports on this. This has been recognized again a century ago. The Big Five dominating, lack of competition, the Big Five failed to provide long-term investment. All these things were announced in a report in 1918. Of course, it could have been written yesterday. So if you look at bank credit in the in the UK, then 90% is asset credit creation, so credit for financial circulation, the CF, and of course, that's no good. And that's the problem of centralized decision-making. The central planners like an easy life, and they think that's good for them. It's not good for the economy. Another piece of evidence on centralized decision-making is the ECB in the 2000s. So credit creation in Spain, Ireland, Portugal, and Greece was expanding by 30–40% under the watch and auspices and supervision of the ECB. As I had warned, the ECB was going to do this, create asset bubbles, banking crises, and recessions in the Eurozone. And of course, that's what it did. So again, the problem of centralization in the hands of these central planners. Another example, Japan in the 80s. They used the window guidance, credit guidance tool until the 80s for good purposes, but then the central planners, because they're unaccountable and too independent, decided, oh, let's create a bubble. And they announced their window guidance loan growth targets. And I pressed the button, you see the actual result 3 months later. Banks had to follow, and they had to increase their lending for real estate speculation. And that's how the Japanese bubble was created by the Bank of Japan. So centralized decision-making has failed. The evidence on decentralized decision-making is from China, as I mentioned briefly, and Germany. Germany actually has been very successful, its economy, for 200 years, and its exports are often larger than Chinese exports, although the population, only 6% of the Chinese population. How is that possible? In fact, if you look at market champions, these are companies that are number 1, 2, or 3 in terms of market share globally. And hidden champions are small firms that are global market leaders, global champions. Germany has the largest number of hidden champions, small firms that are global market leaders. By far of any country, the US comes second, Japan, and so on. How is that possible? Most exports from Germany are from small firms, family-owned businesses. Well, it's because of the community banks. And the community banks in Germany, there's 1,500. It's the largest number of banks in the European Union. Big banks lend to big companies, small banks lend to small firms. Germany has lots of small banks. Decentralized decision-making, that's been highly successful. 70% of banking, the green 2 segments, are with not-for-profit community banks. We already have public money creation in the form of local community banks, not-for-profit banks. So that's unique in the world, and that's delivered high growth without the bubbles. So central bankers create cycles. How have the central bankers, this is my last slide because my 12 minutes are just up, have reacted to the truth coming out? They admit that they've been telling porkies, and now they propose to increase their power. So central bankers belatedly admit, oh, now that you've mentioned it, yes, banks create the money supply. So let's abolish that now. And also, by the way, let's abolish cash. So what should we do? Well, introduce digital cyber currency that central banks issue and control, and thereby gain total control over all economic transactions, decisions, and the whole lot you've just heard from the CEO of the GDI. So the greatest concentration of central banking power in history is really the bid they're aiming at. That's the central bank's goal. And of course, digital accounts of dissenters and regime critics could be switched off. It'd be very difficult to even purchase necessities. So this is an Orwellian dystopia of total control, the end of any freedoms. That's really what central banks are aiming at. Several central banks have, like the Bank of England, already prepared their microchip implant, RFID chip, to be implanted under your skin. And why is the sudden discussion about universal basic income from all the grassroots and inverted commas movements and billionaires? Oh, universal basic income is the bribe for you to accept the microchip. The overarching trend of the 20th century is concentration of power in the hands of the few. That's what we have to keep in mind. We have to work against this. We don't want to have these unaccountable central planners making decisions. We need decentralization, and the solution, therefore, is to maintain public money in the hands of local community banks, decentralize decision-making, give local people the power in the form of local public banks and local not-for-profit community banks. As I walked in, I was delighted to see that the Gottlieb Duttweiler Institute is also about Genossenschaft and cooperatives. And of course, the majority of banks in Germany are cooperative banks. And that's really what we need. So we shouldn't really abolish banks. We just have to get rid of the too big to fail banks, introduce a few rules that you create credit for productive purposes, and then we can solve many of the world's problems. And these are really the promises of economics, that we can solve a lot of mankind's problems. As JFK said, our problems are man-made, therefore they may be solved by man, and man can be as big as he wants. Of course, he was referring to ladies as well, no doubt. No problem of human destiny is beyond human beings. JFK. Thanks very much.